Hey everyone, welcome back to Alpha Recap from StockAlpha.ai. I'm Martin, relaxed takes, caffeinated thoughts. With me as always is Lucy, who keeps us honest and on the tape. How are you, Lucy?
Hey Martin, great to be here. We've got a packed show today. A whole week of alpha research condensed into one conversation. Big themes, lots of numbers, and some names that are moving fast.
Let's kick it off with the headline. The market is running on AI infrastructure and it's creating a two-speed market. Some names are getting re-rated hard, others are just hanging on. Walk me through that, Lucy.
Sure. Across the research this week, AI is the dominant macro driver. Memory makers, GPU and accelerator suppliers, and data center service providers are getting the lion's share of upgrades and multiple expansion. Think Micron and SanDisk on the memory side, Nvidia and AMD on compute, and companies like Supermicro capturing GPU rack demand.
Micron keeps popping up. Alpha notes it's trading near $363 with a price to earnings around 34. They also flagged a strategic deal and a $1.8 billion tie-up. Seems like analysts are pretty bullish, yeah?
Yes, strong buy tones across several reports, but the research is careful to remind investors that memory is cyclical. So while Micron looks positioned to benefit from a ramp in AI memory demand, valuation and the classic ups and downs of the memory cycle are risks. The $1.8 billion agreement is a signal of capacity expansion and margin improvement, but it's not a guarantee.
SanDisk is in the same mix. Alpha cites something like $400 to $14 and a forward price to earnings near 32, right?
Correct. SanDisk's thesis centers on NAND tightness driven by AI workloads, which supports stronger SSD pricing and cash flow. The research notes reported net losses in recent filings, though, so execution and profit volatility are real headwinds.
And Supermicro, the company that builds those GPU-heavy racks, Alpha highlights a multi-billion-dollar backlog and a strong liquidity position. Current ratio about 5.4, I think?
Exactly. Supermicro looks like a pure demand capture idea ahead of earnings. High backlog and liquidity are supportive, but revenue paths can be volatile. The research frames it as an active idea. You want exposure if you believe GPU rack demand is accelerating, but it's not a set-and-forget position.
So that's the infrastructure angle. What about the cloud and platform monetization side? The research points to cloud giants like Microsoft, Google, Amazon, and Oracle as the companies that actually convert AI into recurring revenue.
Right. Microsoft gets a lot of attention. Price noted around $460 and the analyst mean target near $623. The thesis is Azure plus Copilot monetization driving durable upside. CrowdStrike is another software name highlighted for recurring ARR growth, following acquisitions aimed at identity security.
But not every cloud name is equal. Alpha keeps pointing out that the market is bifurcating between names with clear monetization levers and those priced for perfection. Oracle is a good example. It has that OpenAI partnership and data center build, but it also carries elevated debt and capex.
Exactly. Oracle's forward price to earnings is about 28 and the stance is neutral. The company is building out, but the balance sheet and capital intensity temper conviction. For investors, the key is to separate those with proven monetization, where you can see recurring revenue growth and margin lift, from names that are still structurally leveraged to execution.
Let me ask you a simple one. How do you tell if a cloud company is actually monetizing AI versus just talking about it?
Good question. Alpha suggests tracking ARR growth, gross retention, and cross-sell metrics in software names. For cloud incumbents, look for commentary on incremental revenue per customer, new AI product attach rates, and higher margin services. If a company can show a steady increase in recurring revenue tied to AI features, that's monetization. Otherwise, it's just noise.
Makes sense. Okay, next big thing in the notes was valuation, dispersion, and crowding. Some winners are getting bid up hard. Nvidia gets mentioned a lot, about $186 and a price to earnings around 46, right?
Yes, Nvidia is seen as the long-term leader in AI compute, but analysts flag high valuation and timing risk. Broadcom and other chip names are also being bid aggressively, creating concentration risk. The research uses phrases like a two-speed market and highlights crowding in a handful of winners.
And on the flip side, there are names that look mixed. Shopify is trading at over 100 times earnings, whereas PayPal is around 11 times earnings. That's wild dispersion.
It is. Shopify is priced for perfection. Growth expectations are baked in. PayPal looks like a value-oriented play with lower multiples, but execution on total payment volume and BNPL credit risk are watch points. The research advises keeping conviction buckets, so you don't blow up your portfolio by concentrating only in the crowd.
Speaking of buckets, Alpha suggests a core AI infrastructure bucket, a thematic optionality bucket for milestone-driven names, and an income or defensive bucket. I like that framework. It's simple, practical.
Yes, the idea is sizing positions to the conviction and the risk type. For example, Micron or Microsoft in the core bucket size to your risk tolerance, Zellas Life Sciences or AST Space Mobile in the optionality bucket as milestone bets, defensive names like PepsiCo or Ford in the income bucket for stability.
That brings us to those binary, event-led names. Alpha flagged clinical stage biotech, space commercialization, and small modular reactors as high binary risk. Zellas Life Sciences was one interesting call. Strong buy despite being speculative.
Yes, Zellas has clinical momentum, with its SLS-009 Phase 2 data and an expansion in Europe for Impact AML. Alpha labels it speculative, but shows a strong buy consensus and around 72% upside to mean analyst targets. The note cautions on trial binary risk and potential dilution, so the recommendation is to size these as classic asymmetric bets.
And AST Space Mobile? It surged after a contract from the Missile Defense Agency, but Alpha warns commercialization is still very uncertain.
Correct. The contract is validation, but commercialization KPIs like customer trials and activations are the things that will determine sustainability. Valuation looks stretched versus the commercialization timeline, so it's a measured contrarian. Validate partnerships and operational milestones before assuming the rally sticks.
Then there's Oklo in advanced nuclear. Alpha called out a meta-tie and a big market cap, about $14.8 billion, but it's pre-revenue and milestone-driven.
Exactly. Oklo has marquee partners and liquidity, but regulatory approvals and delivery timelines in the small modular reactor space create a long binary path to returns. Alpha suggests patience and sizing as a milestone-driven watch.
Let's pivot to fintech and crypto. MicroStrategy again shows up as a crypto treasury play. Coinbase is somewhere between profitability and regulatory risk. PayPal looks cheap. How are they parsing these?
The notes split fintech into differentiated risk profiles. PayPal looks value-oriented, with a price to earnings around 11 and supportive return on equity. But you need to watch transaction volumes and credit levers. Block and Shopify are growth at a premium stories with multiple monetization avenues. Coinbase is profitable, but exposed to crypto regulatory noise. MicroStrategy is reframed as a hybrid macro and crypto instrument, where Bitcoin accumulation adds convexity, but also big drawdown risk.
I always like when Alpha reminds us to treat these as portfolio decisions. Crypto exposure is an active call, not something you just get as a side effect of holding the stock.
Right. We'd emphasize explicit sizing, stop or trim levels for rich multiples, and clarity on what driver you own. Is it payments volume? Is it merchant services? Is it crypto exposure? Each has different risks and catalysts.
Speaking of catalysts, Alpha mapped a big event calendar, some earnings and trial readouts that could move markets. Any upcoming ones to flag?
Yes, next week in the research agenda, they flagged several earnings and data points. Microsoft on January 28th, Amazon on January 29th, Apple on January 29th, Boeing on January 27th, Intel on January 22nd, and Netflix on January 20th. Memory cycle data points, NAND and DRAM, average selling prices and order books for Micron and SanDisk, are also important.
So, during earnings season, we should prioritize liquidity and add on confirmed execution rather than chasing headline excitement. That's the play.
Exactly. Alpha recommends planning to add on confirmed execution, not on sentiment. Earnings and guidance will be the real read-throughs for AI monetization and data center demand.
Let's get into patterns Alpha called out across coverage. One is convergence. AI increasing memory intensity, driving GPU and server demand and expanding addressable markets for cloud incumbents. Two is re-rating concentrated in a narrow set of winners, which creates crowding risk. Three is M&A and partnerships matter. Anything else?
Yes, two more. 4 is the split between profitability inflection stories and valuation traps. Some names are improving GAAP or free cash flow, and others are story stocks with uncertain near-term cash generation. 5 is elevated event-driven risk, earnings, trials, regulatory rulings that can quickly re-rate names. Those 5 patterns are the backbone of Alpha's flow this week.
I liked the contrarian calls they pointed out. Zellas as a clinical asymmetric bet, AST Space Mobile as a partnership validated but execution risky name, MicroStrategy as a macro-crypto hybrid rather than a pure software play, and Oklo as a patient, milestone-driven watch.
Those are good examples of where Alpha went off the beaten path. They're not big macro calls, more concentrated, high-conviction themes that require active monitoring.
Let's talk risk. What are the major risks that could derail this AI forward rally?
The big ones: a memory cycle trough that reverses pricing momentum, regulatory or legal shocks, from crypto policy to Boeing certifications, macro shocks like a China slowdown or rate surprises, and execution risk in binary themes like clinical readouts or satellite commercialization. Any of those could compress multiples quickly.
And Alpha's methodological take. They anchor each note with prices, valuation ratios like price to earnings, and a couple of ratios like return on equity or EPS trailing 12 months. They also use analyst consensus and catalyst mapping to give a probabilistic spread. I like that. Data-driven but practical.
Me too. They also stress scenario sensitivity for capital-intensive names, show range of outcomes and the variables that matter. For memory makers, that's NAND and DRAM price moves. For miners, it's energy costs. For EVs, it's volume trajectory. It's a framework that helps build confidence intervals around theses.
Before we wrap, Lucy, give me 3 practical takeaways an investor can act on this week.
Okay. 1. Separate your conviction buckets. Core AI, infra positions, size to risk tolerance, thematic optionality for milestone-driven names, and a defensive bucket for stability. 2. Set explicit risk controls, stop or trim levels on richly priced winners, and active monitoring of memory ASPs and GPU backlog conversion. 3. Prioritize liquidity and add on confirmed execution during earnings season rather than buying into hype.
I'll add a practical 4th. If you're in small-cap binary stuff, size like a pilot program. Small, track milestones closely, and be ready to exit on negative readouts. Treat them like research experiments, not core positions.
Good addition. And remember to watch regulatory calendars. Crypto policy signals, antitrust developments, and litigation updates can be market-moving and are often underappreciated until they hit.
Lucy, any final color on how fast this two-speed market can change?
Very fast. The research notes that AI narratives can re-rate names rapidly, so price targets can be stale quickly. That's why Alpha emphasizes up-to-date earnings commentary, memory price tracking, and clear catalysts. A single earnings call or a surprise comment on demand can flip sentiment overnight.
All right, let's close with a short recap and sign off. Quick bullets for the listeners?
Sure. First, AI into infrastructure is the primary demand driver. Memory, GPUs, and data centers lead the re-ratings. Second, the market is bifurcating. A narrow set of winners is getting crowded while many names remain mixed or neutral. Third, use conviction buckets, active risk controls, and focus on monetization evidence from cloud and software names. Fourth, size binary and milestone-driven names, small, and monitor catalysts closely. Fifth, watch the event calendar. Upcoming earnings and memory data will be decisive.
Solid. That's our Alpha recap for the week. Thanks for listening. If you liked the episode, tell a friend, and if you're tuning the portfolio, remember, evidence beats headlines. Lucy, see you next week.
Thanks, everyone. We'll be tracking the earnings and memory data as they come in. Stay curious, stay disciplined, and we'll talk soon.